What if I told you there was a fund that gives you exposure to the most powerful, earnings-generating companies on the planet, the companies reshaping how we live, work, communicate, and move, and on top of that, it pays you monthly income while doing it. Most income investors are stuck making a choice. You either chase growth, you buy into the big tech names, you ride the momentum, and you accept that those companies aren't going to write you a check every month, or you go for income. On Maubo on Dividend ETFs, you collect your distributions, and you quietly accept that you're structurally underweighted in the fastest growing sector of the modern economy. That trade-off has existed for as long as income investing has been a thing. Growth investors get the upside, income investors get the check, and rarely do the two meet. But today's guest and today's fund are making a very compelling case that you no longer have to choose. Welcome back to Dividend Desk. I'm your host, and today we are sitting down once again with Howard Chan, the CEO and founder of Curve ETFs, a name that by now should be very familiar to anyone who's been following this channel. We've had Howard on before to talk about their commodity funds, KGLD, KSLV, and KOP, and today we're going deep on what I personally consider one of their most exciting products, KQQ, the Curve Technology Titan Select ETF. This is a growth plus monthly income technology fund, and what makes it stand out, especially right now in this volatile, uncertain market, is that it has maintained positive total returns since inception, despite everything the market has thrown at it this year. We're going to cover everything today: how the fund is constructed, why it's different from just buying the QQQs, how they generate that monthly income without capping the upside, how they're thinking about the current correction in tech, what the distribution rate means, and how it's set, and who this fund is really built for. This is a long one, and it's worth every minute. Let's get into it.
Quick disclaimer. The content in this video is for educational and informational purposes only and does not constitute financial, investment, or tax advice. Dividend Desk is not a financial advisor. Please do your own research and consult a qualified professional before making any investment decisions.
Howard, welcome back to the channel. Always great to have you here. Now, most income investors who want technology or growth exposure tend to just default to something like QQQ, a NASDAQ 100 ETF with an options overlay. You did something different with KQQ. Walk me through why you launched this fund and what makes you excited about it.
Thanks for having me back. So we launched the Tech Titan strategy really as a response to how people are actually allocating in their portfolios. As you mentioned, many investors treat QQQ, the NASDAQ 100, as a proxy for technology exposure. But when you look under the hood, the NASDAQ 100 is simply the top 100 names listed on the NASDAQ exchange. And it's not purely a technology fund. Yes, about 60% of it is technology exposure, but the other 40% includes financials, consumer discretionary, and other sectors that have nothing to do with the kind of technological innovation we're talking about. So our premise was, what if we built something pure? Something that gives you exposure specifically to companies that are using technological innovation to fundamentally change the dynamics in their industries? And our definition of technology is broader than just the NASDAQ listing. Think about Netflix. They've completely revolutionized how we consume entertainment. Uber and Lyft have changed personal transportation. These are technology companies in every meaningful sense, regardless of which exchange they trade on. And that's the other piece. There are genuinely great technology companies listed on the New York Stock Exchange, Spotify, Oracle, and others that get left out of NASDAQ-based funds simply because of where they're listed. We wanted to capture the best names in the space, regardless of exchange, regardless of geography, as long as they fit our definition of a technology titan.
I love that framing. So this is really a pure play tech fund, not a NASDAQ fund. And then on top of that purity of exposure, you're layering in the monthly income component. Before we get into the mechanics of how you do that, I want to hear more about the companies themselves. Why tech specifically? Why is this sector worth building an entire strategy around?
It's a great question, and it gets to the heart of why we believe in this space. The obvious answer is AI and the ongoing technological revolution. By now, everyone's heard about that. But the deeper reason is the earnings profile of these companies. Many of the mega-cap tech names have delivered consistent earnings growth not just for the last 5 years, but for the last 20 or 25 years. every year. Through recessions, through market crashes, through global pandemics. That kind of durability is extremely rare. And what's interesting is that the normal rules of economics suggest that as a company gets larger, its growth should slow down. That's how most industries work. But these technology companies keep growing at 15–20% per year, even at massive scale. The reason, in our view, is that they essentially function as monopolies or price setters in their core markets. And then once they've saturated that market, they move to the adjacent sector and dominate that too. Amazon is the textbook example. Started in retail, dominated it, then moved to cloud computing with AWS, and dominated that. Now they're in advertising, in healthcare, in logistics. They don't stop. And that expansion into adjacent sectors is what continues to drive the earnings growth and the price appreciation that ultimately attracts investors.
Now let's get into the philosophy behind how KQQ is actually managed, because this is where it gets really interesting. Most income investors are familiar with covered call ETFs. You sell calls against your holdings, you generate the premium income, and you pay that out as distributions. But you've made it very clear that total return is the goal here, not just yield. Why?
Right. And this goes back to a fundamental problem we saw when we were designing the strategy. Traditional covered call funds make a very specific trade-off. You sell a call option, you collect the premium, but in exchange, you cap your upside. If the stock rips 30% in a quarter, you don't participate fully in that move. You've already given away that upside to whoever bought the call from you. For a lot of asset classes, that trade-off is acceptable. But for high-growth technology stocks, it can be really damaging. These stocks have short, sharp, explosive moves to the upside. We've seen it again and again. And if you're capping yourself on every one of those moves, you're leaving enormous value on the table over time. That's why a lot of the traditional NASDAQ covered call funds have underperformed the QQQs on a total return basis, even accounting for the income they pay. So when we built KQQ, we asked ourselves, what would we actually want to own? And the answer was clear. We want the growth and the income. We don't want to sacrifice one for the other. So we built a structure where we can generate income from the option strategies, but we also maintain upside participation through call spreads and other mechanisms. When the market runs, we participate. When it moves sideways or down, we clip the coupon. That's how we think about maximizing total return.
And just to be clear for viewers, the internal benchmark you're comparing against isn't just KQQ. You're actually benchmarking against the NASDAQ 15, which is the top 15 components of the NASDAQ index. So you're trying to keep up with or outperform the most elite concentrated subset of the NASDAQ while also paying monthly income. That's a high bar.
It is. And we chose that benchmark intentionally because we believe that over time, technology companies outperform non-technology companies. So comparing against QQQ, which has 40% non-tech, would be setting the bar too low for what this strategy is trying to accomplish. The NASDAQ 15 is mostly pure technology exposure, and it's a much more honest comparison for what we're doing. Since inception, the strategy has outperformed that benchmark, and we think the combination of tech focus, active security selection, and the income overlay gives us a real edge over time.
Let's talk about what's actually happening right now in the market, because this is recorded during a period where we've seen significant corrections in technology and growth stocks. The NASDAQ is down, volatility is elevated, and there's a lot of geopolitical uncertainty. What do you say to investors who are current shareholders in KQQ and are watching their share price come down?
The first thing to understand is that we constructed this strategy as a long-term structural holding. The investment horizon we're designing for is a minimum of 3 to 5 years. This is not a trading vehicle. It's not meant to be evaluated on what it did last month. And actually, the recent period is a perfect illustration of something worth understanding about the fund. Starting in December, technology started to underperform, and there was a sector rotation. Non-tech names, consumer staples, defensive sectors started leading the market. In that environment, KQQ underperformed QQQ, and the reason is exactly what I described earlier. QQQ has 40% non-tech exposure, and that 40% was actually the part of QQQ that was doing better. Our pure tech exposure hurt us relative to that. But here's what's also happened more recently. As uncertainty has shifted toward more macro and geopolitical risks, we've actually seen technology, particularly mega-cap tech, start to reassert itself as a place of relative safety within equities. These companies have fortress balance sheets. They have enormous cash flows. The probability of a company like Apple or Google encountering financial distress in the next 3 to 5 years is essentially zero. In an uncertain market, that matters. Within the equity universe, mega-cap tech is actually a refuge compared to smaller, more leveraged companies.
That's a really important point, that within equities, mega-cap tech can actually serve as a defensive position when things get rough, even though people often think of it as the highest risk bucket.
Exactly. And to be clear, I'm not saying there's no short-term volatility risk, there clearly is. But if you understand that the underlying companies are not at risk of default, that their earnings remain strong, that the AI investment cycle is still in early innings, then a down period like this is less a red flag and more a potential opportunity for long-term investors.
Let's talk distributions, because that's something a lot of Dividend Desk viewers focus on closely. KQQ currently has roughly a 20% annualized distribution rate. Does Curve have a target yield for this fund, and how did you land on that number?
We don't set a fixed target yield. What we actually do is let the implied volatility of the underlying asset class set the distribution rate for us. It's a very intentional approach. Assets that are less volatile should generate less premium from option strategies, so they should have lower distribution rates. Assets that are more volatile can generate more premium, so the distribution rate naturally rises. Technology stocks are more volatile than the broad market. Anyone who's watched the NASDAQ knows that. So the option premiums we can harvest in this space are meaningfully higher than what you'd get from an S&P 500 covered call strategy, for example. That's why the distribution rate on KQQ is higher than what you'd see on our commodity funds or a broader market income fund. But, and this is important, we don't just maximize the distribution rate. We're always asking, can we sustain this? Are we distributing more than the portfolio is generating? Because over-distributing erodes NAV, and NAV erosion is the silent killer of income funds. If you're paying out more than you're earning, you're slowly liquidating the fund. We would much rather be conservative, pay a little less, protect the NAV, and then increase distributions later when conditions support it, than overpromise, overpay, and leave investors with a declining share price.
And we've actually seen that reflected in the historical payment history. Distributions started around 15 cents per share and have since moved up toward the 41-cent range on average. Can you walk us through why that happened?
That increase tracks very closely with what the underlying market was doing. From roughly March 2025 through the following several months, we had a sustained risk-on environment where volatility was elevated but in a constructive way. Markets were moving, there was good premium to harvest, and risk assets were performing well. That allowed us to increase distributions in a sustainable way. Now, given the current environment of heightened uncertainty, we're likely going to moderate distributions slightly for the near term. Not cut them dramatically, moderate them. Because in periods of uncertainty, we want to make sure we're only distributing what we've actually earned. The moment we start paying out capital as income is the moment we start damaging the portfolio in a way that's very hard to reverse. We can always pay more later. We can't take back what we've already distributed.
Let's get into the actual portfolio mechanics. How does KQQ decide which stocks to own, how much of each, and how often to rebalance?
The starting universe for us is the NASDAQ 15. The top 15 names on the NASDAQ by market cap. We strip out any non-technology names from that list, so something like Costco, which is in the NASDAQ 100, gets excluded from our universe even though they use technology for logistics. Then we layer in technology companies from other exchanges, Spotify, Oracle, others that fit our definition of a technology titan regardless of where they're listed. From that universe, we do fundamental analysis on which names to own, how much to own, and how to express that ownership, either through direct stock or through synthetic longs using option structures when we want to be more tactical. We also use a momentum overlay. Growth stocks have a very well-documented tendency to exhibit momentum. When they start moving, they tend to keep moving for about 9 months on average. So when we identify a name that's starting to build momentum, we'll begin overweighting it modestly at month 2 of the cycle, then add more weight around month 5. We want to be adding on the way up, rather than waiting until the top. For names that aren't in a momentum cycle, going sideways or slightly down, that's actually where a covered call strategy makes the most sense. You're not going to hit the call cap when the stock isn't going anywhere. So we clip the coupon on those names while riding the momentum on others. And then the last layer, which I think is genuinely differentiated, is downside protection. We buy outright puts on specific exposures within the portfolio. These are tail risk hedges that cost something in premiums but can significantly mitigate drawdowns during sharp corrections. During the recent sell-off, those puts contributed meaningfully to relative performance versus the benchmark.
And in terms of rebalancing frequency,
in a momentum-driven environment like we had for much of 2023 and 2024, we only rebalance the core equity positions quarterly. Keeping transaction costs low is a real priority. For the option strategies that generate income, we roll those weekly or bi-weekly depending on where implied volatility is. And we reset the strikes as the market moves so we're not permanently capping our upside. If a stock has run up significantly, we reset the call higher so we can continue to participate.
some investors are going to push back and say, why not just buy a NASDAQ 100 covered call index ETF? It's cheaper, it's passive, you don't have to worry about someone making the wrong call on Oracle or Google. What do you say to that?
It's a fair question, and I'll be direct about where we're coming from. Curve is built by active managers. Every person on our team came from an active management background. We believe in it. But beyond belief, there's a real argument for active management in the current environment that wasn't there a decade ago. When rates were near zero, everything went up together. In that environment, picking individual winners didn't add much because the tide was lifting all boats. Passive made a lot of sense. We're not in that environment anymore. Short rates are significantly higher. Earnings are diverging sharply within sectors. You have companies in the same industry performing completely differently based on their AI exposure, their balance sheet quality, their specific business model. That idiosyncratic differentiation is exactly where active management has the opportunity to generate alpha. And we've seen that reflected in how much capital has been flowing back into active management globally over the last couple of years. Can we guarantee we'll always pick the right stocks? No. No honest fund manager can say that. But we have a rigorous process, we have downside protection built in, and we have a track record since inception that we think supports the case for our approach.
And the expense ratio on this fund?
The net expense ratio is 99 basis points. Without acquired fund fees, it's 92 basis points. One thing worth noting, the fund can hold some of our own single-name ETFs. For instance, we have a Tesla option income ETF. And when we use our own funds, we rebate those fees back to the investor. We don't double charge. Any fee associated with our own ETFs held in the portfolio comes back to KQQQ investors.
Let me ask you the big picture question. How do you see investors actually using KQQQ in their portfolios? Is this a core holding, a satellite position, a complement to something else?
We think it works as a core holding. The underlying companies, the Googles, the Apples, the Microsofts, these are the growth engines of the economy. Owning them as a core exposure makes sense for most investors who have a multi-year time horizon. In terms of volatility, technology stocks run at roughly 20% annualized volatility versus about 12–15% for a broad equity index. So it's marginally higher, and investors should understand that. But in exchange for that extra volatility, you're getting exposure to companies that have compounded earnings at 15–20% for decades. That trade-off is very favorable in our view. The income angle also serves a specific function. Traditional dividend ETFs are structurally underweight technology because tech companies don't pay dividends. So a typical dividend ETF is overweight utilities, financials, energy, the slower growth, older parts of the economy. If you pair a traditional dividend ETF with KQQQ, you can actually get a combined sector exposure that looks very close to the S&P 500, but with a meaningfully higher combined yield, potentially 6–7% versus the S&P 500's roughly 1.25–1.5%. That's a very compelling construction for income-focused investors who don't want to sacrifice tech exposure. And from a tax efficiency standpoint, because we're using single-name stocks and actively managing gains and losses within the portfolio, the return of capital percentage in distributions tends to be relatively high, which means a meaningful portion of the income you receive is tax-deferred. Not all income is equal, and we think KQQ's income profile is quite favorable on an after-tax basis compared to many alternatives.
Howard, before we wrap up, what do you say to the investors who have been in KQQ since early on, who believed in this fund before it had a long track record, and who are now sitting through a tech correction? What do they need to hear right now?
First, thank you. Genuinely. We're a relatively young firm, and building trust takes time. Every investor who came in early and gave us the opportunity to prove ourselves, that means a lot to the team. What I'd say is this: the companies in this portfolio are not going away. They are not going bankrupt. They are not losing their competitive position overnight. What we're seeing right now is a market repricing driven by macro factors and uncertainty, not a fundamental collapse in the earnings power of these businesses. The long-term thesis is intact. The AI infrastructure build-out is ongoing. The dominance of these companies in their respective sectors is ongoing. Short-term volatility is the price of admission for long-term outperformance. And what I can tell you from decades of experience is that the investors who stay disciplined through periods like this are typically the ones who end up with the best outcomes.
Howard Chan, CEO and founder of Curve ETFs, always a pleasure. That was a masterclass in how to think about growth and income investing in the technology sector. For everyone watching, if you want to learn more about KQQ or any of Curve's other strategies, make sure you do your own research and check out the links below. If this video added value to your investing education, please hit the like button and subscribe to Dividend Desk so you don't miss what's coming next. Drop your questions about KQQ or any other fund you want us to cover in the comments. We read every single one, and your questions directly shape the content we produce. This is Dividend Desk. We'll see you in the next one.